All right, let's get right into it. Picking the right Singapore REIT ETF can feel, well, a little overwhelming, right? But it's honestly one of the best ways to get a slice of that Singapore property pie. So today, we're going to cut through all that noise and make this choice super simple and crystal clear for you.
I mean, who doesn't, right? It's a dream for so many of us. You look at that iconic skyline, and you just want a piece of it. A stake in what is, let's be honest, one of the most stable and sought-after real estate markets on the entire planet.
But then comes the reality check. For most of us, the amount of cash you need, we're talking millions, it just feels like a giant wall. So the big question is, how do you get in on the action without needing a seven-figure bank account?
Well, this is where the magic happens. It's called an S REIT ETF. And honestly, it's such an elegant solution. Just think of it like this. It's a whole property portfolio all bundled up in one neat little package. You're not buying one building. Nope. You're buying a tiny piece of dozens of malls, offices, warehouses, you name it. And you do it all with a single click, just like you'd buy a share of Apple or Tesla.
All right. So now that we're on the same page about what these things are, let's meet the main players. There are a few options out there, for sure, but we're going to zero in on the top three. The big contenders that, honestly, will cover the needs of pretty much every single investor out there. And what's cool is that you can kind of think of these ETFs as having their own personalities. First up, you've got CLR. This is your safest all-rounder, the steady, reliable one. Then there's SRT, the highest yield option. This one's all about maximizing that income. And finally, we have CFA, the regional diversifier, for when you want to look beyond just Singapore's borders. So how in the world do you choose between them? Well, we're going to use a really simple three-point checkup. We're going to focus on what really, truly matters: yield, fees, and strategy. In other words, how much do they pay you, how much do they cost you, and what are you actually buying?
Okay, first up, yield. This is the good stuff, the cash they pay you just for owning a piece. And boom, right away you can see SRT is leading the pack at 5.77%. That's what it's built for, to squeeze out as much income as possible. But you can also see that CLR and CFA are not far behind at all. They're all really competitive.
But hang on, a high yield is only half the story. You've got to look at what it costs you. And this is where it gets interesting. Check it out. CFA, the regional one, is actually the cheapest to own. Its fee is just 0.5%. Now, that might not sound like a big deal, but trust me, over decades, that tiny difference can literally save you tens of thousands of dollars. It really adds up.
So you might be asking, why the different yields and fees? Well, it all comes down to what's under the hood, their strategy. Take a look here. You can see both CLR and SRT are packed with industrial properties. We're talking warehouses, data centers, the stuff that powers all our online shopping. That's a huge growth area. CFA, on the other hand, spreads its bets out a bit more, not just in different kinds of properties, but in different countries too.
Okay, so we've crunched the numbers. We've looked under the hood. Now for the fun part. Let's play matchmaker and find the perfect ETF for you and your specific goals.
First up, let's talk about profile number 1, the conservative income seeker. This is for you if you're looking for stable, predictable income without any crazy ups and downs. Maybe you're retired or you just really value keeping your capital safe. Low drama is the name of the game here.
If that sounds like you, then the choice is pretty clear. Your best bet is going to be the Lion-Phillip S REIT ETF, ticker CLRE. It is literally designed for this kind of stability.
And here's the why in 3 simple points. 1. Stability. It's the biggest one out there, which means it's super stable and easy to trade. 2. Quality. It has this smart screening process that kicks out financially shaky companies, making your dividend income that much safer. And 3. Balance. You get that great yield we saw, but without being overly concentrated in just one or two things.
All right, on to profile number 2, the growth-oriented wealth builder. This is for someone who's playing the long game. Maybe you're in your 30s or 40s, and your main goal is to reinvest those dividends and just let the power of compounding build some serious wealth over the next 20 or 30 years.
If that's you, then you're going to want to look at the one that's built for maximum returns, and that is the CSOP iEdge S REIT Leaders ETF, or SRT.
So why SRT? Well, it's all about that maximum yield. That 5.77% we saw earlier, that's an absolute powerhouse for growth when you reinvest it. It gets that high yield by focusing on the biggest blue-chip REIT leaders. Now, there's a trade-off, right? It's a bit more concentrated, but that's the calculated risk you're taking for that higher potential income.
And finally, profile number 3, the diversified Asia investor. This is for the person who loves the idea of property income, but thinks, hey, why stop at Singapore? You want to spread your wings, lower your risk, and tap into some of the other amazing growth stories happening all across Asia.
If you're sitting there nodding your head right now, then I've got good news. The Amova AM StraitsTrading Asia ex-Japan REIT ETF, that's ticker CFA, was pretty much made just for you.
And CFA has some killer features. First, remember those fees? It has the lowest, which means more money stays in your pocket. Second, it gives you that regional reach. Instantly, you're invested in Hong Kong, India, and other places. And here's a really cool bonus. It's the only one of the 3 that pays out dividends every quarter, so you get that income stream more often.
Okay, before you run off and start buying, we need to have a serious talk about one huge mistake to avoid. And I'm not kidding. Avoiding this one thing is way more important than picking the perfect ETF from the 3 we just talked about.
And that mistake can be summed up in one number: 50%.
Here it is. Putting 40 or even 50% of your entire portfolio into REITs is a massive, unforced error. Look, REITs are a fantastic tool. They're great for income, but they're just one tool in the toolbox. For almost everybody listening, the sweet spot for how much to put in REITs is somewhere between 10 and 20%. That's it.
So, what's your action plan? It's as easy as 1, 2, 3. 1. Open a brokerage account. Go with a low-cost one like IBKR, Moomoo, or Tiger. 2. Start with a core holding. If you're not sure where to begin, just start with CLR. It's the safest default choice for most people. And 3, and this is crucial, automate it. Set up a monthly investment and make sure those dividends are automatically reinvested. That's how you let compounding do its magic.
And that really brings us to the single most important point of this whole thing. Please don't get stuck in analysis paralysis. The honest truth is that just starting to invest and doing it consistently every month matters so much more than stressing about picking the one perfect ETF. Just pick the one that fits you best, get started, and let time do all the heavy lifting for you.